Ooh, yeah. Let's go, baby. Coca-Cola reported some earnings this morning. Stock's down a little bit, right? But the whole market's down. So, am I too upset about it? Not too upset about it. Let's take a look at these earnings because Coca-Cola is one of those companies where you realize this is the recession-proof stock right here. No matter what happens, people are drinking their Coca-Cola. In fact, probably more than ever. So, Coca-Cola, we're going to talk about this. Is it worth buying Coke stock right now at these levels? Let's look. So, first off, I must say, what a huge surprise this is. This is a huge surprise. Look at this. Coca-Cola non-GAAP EPS beats by 7 cents, 51 cent GAAP EPS 64 cents. They beat by 20 cents. That's massive. Especially if you think about, obviously there's not a lot of economic impact for them. It was really just the back probably 20 days of the quarter. But regardless, that's a big beat, especially for Coca-Cola. They don't usually hit those beats. And from a revenue perspective, down 1% year over year, but they beat by $280 million. So that profitability meet it's not often that you see Coke do something like that, especially from that GAAP EPS standpoint. That's a great job. That's all I can tell you. It's a good little earnings report right there as far as those numbers are concerned. What else do we have to look at, though? Reports organic sales were flat in quarter one to top the consensus estimate of a 2.2% drop. Organic sales were up 4% in North America to offset a 5% drop in the Asia-Pacific region. So these Asia-Pacific people, they don't want to drink any organic products from Coke, apparently. Clearly. No, they've been rocking that organic sales, so that's been major for them. To see a flat is not necessarily good, but it's kind of their second revenue or second avenue for growth. It's a company that's been stagnant, obviously, because it's hard to grow when you're a beverage company and you've really already reached your audience. It's hard to necessarily grow. Organic sales were up 4%. Love that. But operating margin, 30.7% of sales versus 28.2%. That's right. That's what I'm talking about. I'm a huge fan of that. That's a good increase in margin. That's where you see the EPS growth. The company says it will continue to gain value share in total non-alcoholic, ready-to-drink beverages. Looking ahead, Coca-Cola warns on away-from-home sales volume. So that'll be stuff like restaurants, is what they're referring to there. So since the beginning of April, the company has experienced a volume decline globally of approximately 25%. Woo! With nearly all of that decline coming from away from home channels, as in restaurants, which you can't go to. With nearly all that decline, that's wild. Coca-Cola believes the pressure on the business is temporary and remains optimistic, seeing a sequential improvement in back half of 2020. A formal full-year guidance was not issued. So, and I 100% agree with them. Obviously, typically these companies, they're not going to say something negative towards themselves. They don't do it. They're going to say the optimistic part, but I'm with them. And I think we all know people who are trying to home cook, they're going to go back out to restaurants as soon as we can. And there's a lot of states that are already reopening restaurants, stuff like that. So this is going to be massive for Coke. And obviously this quarter is going to be probably half of their quarter is going to be impacted by this, so you're going to see a decent revenue drop. It's what they do with that revenue in terms of operating margin that'll really determine that. So I think EPS is going to be more important than revenue for this quarter because, well, revenue is going to be kind of a hit, and we expect it to be a hit. But if it's not as bad as we assumed, that'd be fantastic. So again, I'm talking, by the end of May at least. So you might see 2 months impacted, 2 months of the 3 months in the quarter impacted for Coca-Cola, but by the end of May, we'll have restaurants open in every state, should be every state. And people will be flocking out to those restaurants. Let's just be fair. People are tired of home cooking. They're tired of eating leftovers. They're tired of eating garbage from the freezer. Just how it is. So they're going to see that revenue come right back to them, and in fact, probably a little bit more because a lot more people are probably buying Coca-Cola just normally. They're just buying it from Walmart or buying it from their local grocery store. They're buying Coca-Cola products because they want to drink some sodies at home. You want to know why? There's many reasons for it. Coca-Cola obviously is it's whatever you want to describe it as, but it's high sugary beverages typically for the most part. They're working on obviously the organic, no sugars, but for the most part, their main business has got to be the high sugar soft drinks. People will drink more of those in times of not being happy. Same thing with in line with like people drinking more alcohol. People smoke more, and people will drink more sugary beverages. People tend to do a lot more unhealthy habits in times of high stress, like right now. So you're going to see a benefit for Coca-Cola over here for this year. It's going to be a good year for Coca-Cola. Hear me out. It may just be a bad quarter coming up, but the second half of the year is going to be good for them. Let's look at the presentation and get some final thoughts on this. So, what a great company right here. Sympathy for all those affected by the pandemic. Whew. Oh gosh. Resounding thank you to the healthcare community, employees, bottling partners, customers, and all those working to keep us safe. That's me. That's me. That's me, dog. Thank you, Coke. Oh gosh. They're striving to make a difference in communities they serve. The Coca-Cola Foundation has awarded $40 million in humanitarian aid, benefiting more than 17 million people in communities across the world. Fantastic. Costa Coffee donated 250,000 hot drinks to National Health Service workers. Thousands of Costa Coffee cans are being delivered to hospitals. Very generous of them. Very generous. Costa Coffee is a new acquisition for them. Fantastic that they're doing that. It's just crazy. And you think about that, and the EPS line still looking good. They're really rocking it. Millions of dollars of planned marketing spend donated to personal protective equipment, or PPE, and beverages for healthcare workers. Let's be honest. If I'm taking care of someone with that COVID, I'm going to go ahead and drink a little bit of Coca-Cola right after. That's what I'd like to do. So I'm into that. So what we are learning, the actions we are taking, they're emerging strong, or the financial strategy, and the question and answer is what you're going to get in this little bracket right here. So they started the year strong. 3% volume growth through February. Crazy. Gaining market share and solid innovation pipeline. The impact of the Ronies is going to be a sharp decline in away from sales, representing approximately 50% of the business. Is going to be what's done at restaurants. Some level of pantry loading at home. Again, people are loading their pantries with freaking Coca-Cola. And they've had a significant increase in e-commerce. People are buying Coca-Cola online. So approximately 25% volume decline through April. Crazy. You don't like to see that, but again, heck, I think they're going to do well. We're seeing 3 phases to begin to form. Phase 1, obviously the outbreak, heavy lockdowns, sharp declines in stay away from home, the restaurants category, shelter-in-place mandates means people are going to be loading their pantries, social distances, steep declining in consumption overall because not many people are going to stores, which is not actually necessarily true. More people are going out to grocery stores than ever, and people are eating more than ever. So gradual reopening is phase 2. They're going to see stable trends in at-home channels and overall improvement trends in consumption. And finally, the new normal, as they want to call it, phase 3, fear and uncertainty are expected to subside, a robust assessment of economic impact, and some behavioral shifts expected to remain, as in more e-commerce traffic. Fair. I frankly think just as many people are going to be going out to restaurants as prior to this. If you're talking about the second half of the year, everyone's going to be going out to restaurants like they normally would. I understand there's a quote-unquote new normal, but I think I think we'll be fine. So, understandable, but I do think they're accurate that the e-commerce probably will take over a little bit further. Early signs from China. Which are you going to freaking know about this? This is their data here. So they saw a solid start of the year. with a positive double-digit volume growth. I was curious there for a second what double D meant, and I was excited, if you know what I mean, but it meant double digits, sorry. Strong sell-in for Chinese New Year following strong activation. They're gaining NRTD share, non-alcoholic ready to drink, in case you were curious. Hey, my brain's just on a new level right now. Heavy lockdown with volume down 65% in February. Then March to mid-April, they saw a strong focus on Coke brands. They saw an upsurge in e-commerce, approximately 50% from quarter one. It's 50% gain in e-commerce. And they gained sparkling share with e-commerce channel. And number of active customers outlets improve, but still well below pre-crisis levels. So, the new normal, they don't know what phase 3 looks like for China quite yet, but they are leveraging strengths with moving with speed. So the global workforce is working together. They're engaged in aligned systems, present a clear path forward. They're going to obviously have strategic alignment, scale and improvement, improved execution, and a winning culture. It's volume to value growth. Look at that. And they're driving the strategy and recalibrating accordingly. They're building brands, innovating, revenue, growth, management, and execution. That's all relative around gaining consumers. They're taking swift actions, adapting to the quote-unquote now. They're maximizing the return on investment with retail customers through focus on core brands, prioritizing key SKUs, maximizing visible inventory, minimizing out of stocks, reshaping innovation pipeline, reallocating resources, and it's a joint effort recovery programs. They're optimizing restaurant customers by package alternatives to fountain, such as pre-canned drinks, stuff like that. They're leveraging drive-through availability, bundle offering for takeout orders, and partner with the U.S. leading food aggregator, as well as active in the Great American Takeout hashtag, meaning you go out and you get takeout. That's cool. It's just called normal life, but package offerings fit for online orders. The mic has attacked me. Don't worry. For refining marketing approach, they're limiting return on investment in outbreak phase. They are working on tailored communication during phase 2, and they're maintaining flexibility while remaining relevant. Revenue growth management 2.0. You see here, look at this. Affordability and premiumization. So they're really working on what's the best, way forward from here. So they're changing packaging here. You see, you got your 2 liters, your mini Cokes, mini Coke can, your 6-pack of Coke bottles. You got Coke Energy. My gosh, they got everything going on right now. They're a system-wide strategy. It's a route to market optimization, supply chain efficiencies. Obviously, supply chain's big right now. Stores running out of product because people are buying so much. Comprehensive playbooks and integrated execution. From scaling new capabilities, they are piloting D2C platforms, scaling B2B home, accelerating alternate routes to market, partnering with national food aggregators globally as well. So confidence in emerging stronger. They are purpose-driven, long-term focused company, leveraging ability to pivot a portfolio. Their accelerated capabilities to drive growth, aligned and engaged bottling system. That sounds like the most boring thing I've heard in my life. And they're transforming the growth culture. So the key topics for their financial strategy are people, profitability, and cash flow, which you can see they made improvement on cash flow and profitability, no doubt. Bottling systems and capital allocation, where they're going to spend their money, and the post-COVID readiness. They are proud and thankful for the sacrifice, commitment, resilience, and adaptability of our workforce. The agility we are seeing across the world in this regard has been impressive and is opening the door to new ways of working. Job security is a key concern and a key priority as we navigate through this period. My guess is I don't think they'll be needing to furlough employees. There's a good chance that they could to help profitability, but I think we'll make it through this without them having to. And we're committed to not making any major restructuring decisions during this period. Many levels to maximize the profit and cash flow. So the approach for the protect the top line. Protecting the top line, they're going to make changes to a brand/pack portfolio, such as what they're packaging, whether it be the cans, bottles, how many come in a case, or whatever it might be. They're leveraging playbooks on affordability and value. They're reassessing marketing spend by staying close to consumers in a relevant way and remaining disciplined to the demand appropriate return on investment. They're recalibrating trade dollars from sizable opportunity in big in North America. BIG, I should say. Notorious, I might even add. They're reallocating and adjusting accordingly. Their attack discretionary spend is going to be challenging every dollar spent and looking across all aspects of our OPEX spend. So every single expense that they're making, they want to find a reason for it. And they're restaging capital projects, only proceeding with committed and essential spend in Q2, and they're providing a half to optionality as we move forward. So they are obviously solid liquidity, solid progress in 2019 on free cash flow, strong demand for our March $5 billion debt offering. They did offer a debt offering in March, obviously to just make sure that they had the money to get through. $9 billion in untapped backup lines of credit available at attractive rates if they need it. Hopefully they don't. Secure $3 billion commitment-backed loans, and there are no concerns today on liquidity at all for them. They're working on reinvesting in the business, continue to growing the dividend as usual, as I expected. I told you they'd be growing the dividend. They're just continuing to grow. It's dividend king. That's why I keep the money in them. Consumer centric, and they are obviously net share repurchases. They're going to work on purchasing shares over time. And obviously, probably not right now, but we'll see. They're battle tested from previous macroeconomic challenges. This company's been around forever. They know crisis. This is a little bit different on one, but I don't think it hurts them as much. Their immense admiration for all they are doing to stay close to their customers. Proactively taking steps to preserve cash and strengthen the balance sheet and managing profit and loss. Currently, there's no major concerns surrounding the partners. There you go. And their current 20 outlook, they're unable to provide a current outlook. They're expecting mid-single-digit currency headwinds on comparable revenues and high single-digit currency revenues on comparable operating income. So they might get hit a little bit on that, no doubt. So that's exciting. Exciting stuff for this. The only other thing I like to look at, and I like to look at it, we're scrolling through. We like the presentation, but we also like to look at the balance sheet, okay? As of March 27th, end of the quarter, they had total current assets of $13 billion. Again, that's because they raised debt versus last quarter where they had $6.4 billion. So massive growth there, but it's because they raised debt. So total cash and cash equivalents right now of $15 billion versus $8 billion previously. So total current assets actually total of $28 billion versus $20 billion or $20.5 billion. So that's crazy. And a total altogether assets of $94 billion versus $86 billion last quarter. From a liabilities perspective, you don't see much in terms of the current liabilities change at all. The long-term debt you did see change quite a bit because you saw that extra $5 billion in there. Current liabilities of $32.3 billion, which is right in line with their total current assets. It's not lovely, but it's not horrific as well. Not horrific, so nothing too awful. So overall, lovely total assets. You like to see it. Long-term debt you don't necessarily enjoy seeing, but overall the company's doing well. Honestly, I'm okay with what this company's doing. I am under the opinion that I'm buying this company still. It's right around cost basis for me, a little bit above still. But I'm still going to keep money flowing into this company for many reasons. This is a dividend king, and they will continue to grow their dividend and keep it the same regardless. But they will be growing their dividend, and I like that. This is a company that I will look 10 years down the road, and I'll be happy with. On top of that, hear me out. This is a weird thesis, but I know it's true. Because of everyone staying at home, we are going to be having the COVID boomer generation. I don't know if people buy it. I think there's going to be a lot of people doing the dirty. They're going to have a lot of kids popping out 9 months from now. You talk about 10 years, 12 years, 15 years down the road, there's a lot more Coca-Cola consumed. It's all I'm telling you. It's all I'm telling you. Hey, people are going to be popping out babies like no other. Oh.